Today, we're not just looking at some document. We are dissecting a genuine battle plan. This is a professional trader's detailed strategy for one single, high-stakes day in the market, where literally every move is calculated before the opening bell even thinks about ringing. So let's dive in. So the scene is set for March 18th, 2026. And look, this is not just any old trading day. We've got two massive market-moving events scheduled. First, at 2 p.m., the Federal Reserve is going to announce its interest rate policy. Then, just a couple of hours after that, the semiconductor giant Micron drops its earnings. The potential for some seriously extreme volatility? Yeah, it is off the charts. Which brings us to the big question, right? When you know that chaos is basically guaranteed, how do you even begin to prepare for it? Well, you don't guess, and you definitely don't just hope for the best. You create a plan that accounts for every single possibility. And this, right here, this is the heart of that plan, written in all caps right at the top. It sounds kind of cryptic, doesn't it? It's urgent, and it's going to be our guide for today. I promise, by the end of this, you'll know exactly what this means, and more importantly, why it's the absolute key to the entire day. All right, let's start with the morning. The plan kicks off with proactive moves, designed to get into position for the day's big events before most people have even had their first cup of coffee. The number one trade on the watch list is Micron. The reason is crystal clear. Their earnings report is coming out at 4:30 p.m. Now, word on the street is that the company's entire supply of high-end memory chips is sold out for the year, so expectations are sky high. But here's the thing, will the stock soar? Or will it collapse under all that pressure? The plan doesn't try to predict it. It just prepares for it. And how does it prepare? By using a very specific tool, the option straddle. Now, what's so cool about this strategy is that you don't actually have to be right about which way the stock goes. A straddle is basically a bet that the stock is going to make a huge move. Doesn't matter if it's up or down. You're not betting on the direction of the explosion, you're just betting on the explosion itself. The logic here is pretty straightforward. You've got a major event, Micron's earnings, and that creates a ton of uncertainty. The trader has no idea if it's going to be a massive beat or a huge miss. So what do? They bet on both things happening at once. The market is already expecting a move of almost 10%. So as long as the stock moves more than that after the report, this trade is a winner. Simple as that. But hey, this plan isn't a one-trick pony. It also has a bearish play lined up for Lululemon. Now, they actually beat their earnings, but their guidance for the future? Oof. It was a disaster, a 21% miss. The key here, though, is the discipline. The plan is explicit. You don't just short the stock blindly. You only get into the trade if the stock drops hard at the open, and selling volume is super high. It's a plan, not a wild guess. Okay, as we move into the middle of the day, the plan totally shifts gears to defense. There is one instruction that is more important than anything else as that 2 p.m. Fed decision gets closer. And this is it, this one number, 50%. You could argue this is the single most important piece of information in the entire document. The rule is simple, and it is absolutely non-negotiable. Reduce all your positions to half their size by 1:55 p.m. That's just 5 minutes before the Fed announcement. And this, right here, this is what separates the pros from the rest of us. This move has nothing to do with maximizing profit. It is all about survival. It's about cutting your risk in half to make sure you're still in the game after the dust settles, no matter which way it goes. And now it's time for the main event. The plan makes it perfectly clear. The dot plot, which shows where Fed officials think interest rates are headed, is the trade. The market's reaction to this one piece of data is going to dictate the rest of the day. And here is the pure genius of the plan, laid out for all to see. It's a decision tree. There's no room for panic or paralysis. Every possible outcome is already mapped to a specific action. If the Fed signals 2 or more rate cuts, that's dovish, the plan says to immediately buy growth stocks like Nvidia and bet on bonds. If they signal 0 cuts, that's hawkish, the plan says to bet against bonds and get out of those same growth stocks. It's just a giant if-then statement for the market. So it all just boils down to two main pre-planned paths. The outcome of the Fed meeting simply tells the trader which road to walk down. All the hard thinking was done hours ago, in the calm before the market opened. The 2 o'clock decision is purely about one thing: execution. And this really shows you the core philosophy, doesn't it? For this trader, the day's events aren't some surprise you have to react to. They're just a trigger you act on. Reality doesn't change the strategy. It just launches a script that was already written.
So when you boil it all down, this document really reveals a kind of code. You plan for every scenario, you manage your risk like your life depends on it, because in the market, your capital does. You execute that plan without letting fear or greed get in the way. At the end of the day, your edge isn't trying to see the future. The edge is the plan itself.
And that leaves us with a final thought to chew on. We live in a world that is obsessed with trying to predict the future. But after seeing a plan like this, you just have to ask yourself, in a world that's defined by uncertainty, is the real key not making the right prediction, but having the right plan for when your prediction is almost certainly wrong?